The SEC imposing changes on hedge funds and private equity firms on fee disclosures. The move is meant to curb preferential treatment of certain investors. Well, joining us now, Bloomberg's Sonali. Basak, Sonali, is this what we expected?
There are a few things we did expect, to the point that you're making. Increased fee disclosure for hedge funds and private equity firms. This is a $17 trillion industry that has faced some regulation, but now you're watching the SEC under the Biden administration really start to grandfather a new era here for regulation for an industry that has just blossomed. To the point you're also making is that part of this is to limit preferential treatment, sidecars. The idea of giving larger investors, longer standing investors, better terms has really become common practice. And what now Chair Gensler is saying is that they're looking to make sure that one group of investors is not bearing an outsized share of benefits in terms of fees being reduced relative to other investors. Something interesting about this also is that if there are complex deals to cash out those investors sooner rather than later, or to transfer positions from one fund to another, which again has become fairly common practice, they would need an independent auditor to ensure a fair deal across investor bases. Now, there are some wins here for the industry. We've seen hedge funds and private equity firms lobby very aggressively against this rule, which will be voted on today by a 5-member commission.
Yep.
Two of those wins include the indemnification clauses, the idea that investors can sue more easily. They were going to try to lower it from ordinary negligence to ordinary negligence from gross negligence. That is not in the final rule. Another win for the private equity and hedge fund industry here is that there is a grandfathering provision, which means that existing rules and existing arrangements that are in effect with their investors can remain in effect.
Oh.
So these are going to be new rules.
Yep.
And so clearly some wins for the industry here. The MFA, the Managed Funds Association, has said that they could sue within a couple of weeks of this rule being voted on. Let's see with these wins if they continue to do that, given how much they have fought these rules.
It does sound awfully like a draw to me. Like that's if you were to put this on a scoreboard, this looks like a draw. Is that the case? And is this just an example of hedge fund lobbying? This feels like there's been an awful lot of influence exerted here to make sure particularly those two last bits didn't go through. I'm sure hedge funds lawyers are pretty disappointed here, but everybody else must be pretty satisfied, and maybe that was money well spent.
There are some real wins, but remember, this is a private industry that has enjoyed being private, and that was some of the draw here. The Managed Funds Association is a very powerful group. The Founders Council includes Bridgewater, Citadel, AQR, Balyasny. What they do from here will be interesting because, again, these are pretty landmark rules that are being created for the industry that even with those wins, I'm sure they don't want.